My name is Tanner. This is Ryan over here. We both host the Real Estate Investor Meetup. We're both realtors too, so if you have any real estate questions, if you want to buy a house or have any thoughts about a strategy you want to bounce ideas off of, we know all about them. We are both investors and house hackers too. We have long-term rentals, short-term rentals, we rent out garages, all types of stuff in real estate. We've probably done it, garage conversions, ADUs. Please come up and ask us. We do this once a month on the second Thursday, every single month. You can find us on meetup.com, on YouTube too. We do record all of the events. And today, Ryan is going to be talking about assumable loans. And so before we get to that, we do have a couple of sponsors here. Our first one is going to be Ashburton with Right Way Insurance. Would you like to say anything?
If you guys need insurance, I'm happy to help. If not, enjoy it. I'm also here if you want to just talk. So, very good.
Cool. Thank you, Ash. Next up, we have Sam Bromley with Bromley Mortgage Team. Yes.
If you need to finance something, I can finance commercial buildings, commercial builds, residential, anything you can imagine. At this point, we have two arms to our company, so please let me know if you need some cash for something cool. Let me know.
Sweet. And we do have a sign-in sheet over here. It is all digitally, or there are some signs on the tables for a QR code. We are going to be doing a book raffle at the end of it, so if you want to get a free book, please enter. And now give it up for Ryan.
Yeah, go Ryan. Woo. Yeah. All right. Thanks for coming out, y'all. I'm going to talk about assumable mortgages. Who feels like they understand what assumable mortgages are? Sweet. No, I love that because you're going to learn something new. Who thinks that assumable mortgages are sub 2? Subject 2. Who doesn't know what either of those are? Subject 2, yeah. There's a due on sale clause. We might talk about that, but it doesn't impact you with assumable. Those are not the same thing. So if you've heard of sub 2, get it out of your mind. That's not what we're talking about tonight. Very similar ideas, completely different process. So anyways, real quick before I get started, Ryan, I have House Hack Colorado Springs. I'm the assumable guy. I help run this meetup with Tanner. Appreciate you guys coming out. Hope you learned something good. If you got questions and you feel like it's pressing, feel free to ask it in the moment if it's like clarifying something. If not, we'll try and keep them to the end and I'll do a bunch of question and answers at the end.
In real estate, first impressions can make or break a deal. Whether you're listing a home for sale or marketing an investment property, having high quality photos are key at grabbing attention. If you want to stand out in the competitive Colorado Springs market, having high quality photos is essential. And Wayne over at Homadi excels at getting the best possible photos for your property. He is based right here in Colorado Springs and specializes in capturing properties in the best light. If you're ready to take your property photos to the next level, make sure to contact Wayne over at Homadi and mention you heard about him from Tanner at Red and Joy Real Estate to get 20% off your next shoot. Remember, great photos can make the difference between a quick sale and a stale listing. So make sure to contact Wayne over at Homadi today.
So here's the outline. I'm going to talk just real quick about myself, talk about what an assumable loan is, talk about some of the misconceptions, and then talk about the benefits of that, and then show some resources as well. I got started house hacking. So this was my first property that I bought, and it had this funky garage in the front and then a garage in the back. You could drive through, open up a second garage door, and drive through again. It was like tandem garage. At some point in the past, they added this one in the front, I imagine, with that roof. Had 4 bedrooms. I converted the garage in the back into an apartment, and I rented out 3 of the bedrooms while I lived in 1. And so I 2x'd my mortgage. I bought this home for $260K in 2019 and got a 4% interest rate. You can't do that anymore, that purchase price or that interest rate. But that's what the garage looked like. That was the back garage. And we converted this into a studio apartment like this. And we had a bathroom we poked into a laundry room and converted that. I thought it was pretty cool to live for free, 2x my mortgage. And so I thought, I'm going to keep doing this. I turned that one into a rental. I used a lease to cancel out all of my debt as far as the lender was concerned, and used my job income to go qualify for the second property. Also really hard to do today, to set realistic expectations with how much prices have increased in the current interest rates. Really hard to rent your house after year one and cover the mortgage. This was my second house, also close to UCCS. I converted this 2-car garage into a studio apartment, and there was a living room downstairs that I turned into a bedroom and added a closet. This is what, mid construction, and then turned it into this studio apartment that I think turned out pretty nicely, especially with those cool bar stools and the butcher block table. And then over the course of the next 5 years, I scaled to 5 properties. Got this duplex. By the time that I got this duplex, I quit my sales job and went full-time real estate, because these 3 properties were generating enough income to cover my really low cost of living. And so I went full-time into real estate to leverage my experience, help other people do it. I had to wait 2 years before I could buy another property because I started a business. I didn't have a W-2 job anymore. I found a sweet Burr property. Why I couldn't qualify, and so we qualified with my partner's income. I managed the whole flip on this property. It was a massive remodel, total new plumbing, foundation job, landscaping, paints, total remodel on the inside. We were able to refinance and get most of our cash out, turn it into a rental. And then the 5th year, this is where I live currently, over by Garden of the Gods and Red Rocks in Pleasant Valley area. We turned this unfinished basement and then poked into the other basement into a 3-bed, 2-bath. That's on Airbnb. We live upstairs and they get to hear us walk around all the time. But it's great because it really helps cover the mortgage. So that's my story and a little bit about me. It was really easy for me to scale. I got started at a really good time, and I want to emphasize that to create realistic standards or realistic expectations for what's possible today. Rates were good, prices hadn't increased. In 1 year, you could move out, turn the current property into a rental, cancel out your debt on your DTI, and go qualify for another property. As I was a realtor, that worked really well for my clients for 2-3 years, but then rates started shooting up, and my clients that wanted to house hack and wanted to do what I had done could no longer scale. And they couldn't cancel out all of the debt. They couldn't use their job to qualify for the same purchase price and move on to the next property like a lot of house hackers want to do. And so I started looking for what's gonna allow people to do this. Interest rates tripled, right? Prices went up 20+% in 2 years. So my goal with house hackers when they wanted to scale was to help them scale. And so I stumbled upon Assumable mortgages, and I thought, this is the way that my house hacking clients can scale, because they can reach back in time, they can get a loan for a low rate, their monthly payment's going to be $1,100-ish less a month, and in a year they can turn it into a long-term rental, use the lease. That'll cover all their debt, that'll count as income, and they can go qualify for another property. And so I really, about a year and a half ago, really dove deep into Assumable mortgages as a way to help my house hackers scale. And then I realized, oh wow, any primary buyer would benefit from this. And so would some investors, and I'll get to that in a minute. But that's how I kind of stumbled upon it. And don't need to do that. So I mean that's what I want to talk about tonight, is what's an Assumable mortgage, how does it work, what are all the details around it, how do I find them, what are the misconceptions. And so what an Assumable mortgage is the seller can actually transfer their mortgage to a buyer. Everything about that loan. How many years are left on the loan, the monthly payments, the interest rate, the loan balance. All of that gets transferred to the buyer's name, and the lender's involved the whole way. These 3 types of loans are Assumable. The only ones you're going to find in Colorado on the Front Range are FHA and VA. USDA is for rural homes. They don't actually make that good of an assumable mortgage anyways. So you're looking for anything where the seller has an FHA or a VA loan to buy their property. And that's a lot of properties. So in the loan docs from HUD for FHA, from the Veterans Administration for VA, it clearly lays out the seller can let a future buyer assume their mortgage when they sell. And so that's a massive benefit when you buy with these loans, at least when rates are low and then rates rapidly increase. If you go try to sell that home, it's a great way for the seller to market their property and to get their home under contract. A really important term to know when we talk about assumables is equity gap. And the equity gap is your down payment. This is your only down payment. You don't have to put 5% down. You don't have to put 20% down. You got to put whatever the equity gap is. So in this example, the home sells for $525, or that's what you're under contract for. That's what it's worth, right? I'm saying the same thing. The loan balance is $500. This is getting transferred into your name, but you as the buyer have got to pay the seller $25K. You got to pay the seller their equity, what the home is worth. So you're getting this $525,000 home for $25,000, and you're assuming their loan.
What's the motivation to sell a house with low interest rates? Are you going to get to that? I'm just curious.
Why would the seller sell?
If they only get 25K out of the whole thing, and the interest rates are so low, like, is there motivations for why they sell?
Why? That's going to be a slide, and I'm gonna do it right now. Why would a seller want to do that?
BCS.
Yeah, they're moving. They just got to move. They're a veteran that needs to get out of their property and go move to another market. They don't care about being a landlord or keeping their property.
They had triplets.
They had triplets, right? These are reasons for why the seller might be moving, but why would they be willing to let somebody assume their mortgage? Why go through that process with the buyer? Maybe they could maybe get a higher price, right? I would pay a premium all day long if I could get a lower rate. So they could get a higher price. What else is a reason a seller would let somebody assume their mortgage?
They can actually sell it.
They can actually sell the home. The market's slow right now, right? So I've got a $525K house with a 2.5% assumable rate. And my neighbor's got a $525K house, and if you want to buy it, you got to get a rate at 6.5. Which home's going to sell first? All right, my house is going to sell way before my neighbor's.
I had someone tell me that they don't plan on buying after they sell it again. So
Yeah.
They're okay with letting anyone assume the loan, not just the
Yeah, that's a great time where a veteran will let somebody assume the loan, and we can talk a little bit more about the details around why that's important. That answer your question, Ash?
Yep, appreciate it.
All right, here's another example of an equity gap. And 540K purchase price, loan balance 500K. Let's say it's at 2.5% interest rate. 40K. That's what you've got to bring in cash to assume this property. So a little under 10%. This is just an example. These equity gaps are all over the place. I had an investor buy a property 0K down, but they got a 4.9% interest rate, right? Or I had an investor put 120K down and they got a 2.25% interest rate. They'll cash flow $800 a month, right? There's equity gaps as high as 500K, as high as $1 million, right? At some point it stops making sense to put that much down to get a low rate, but the equity gaps are all over the place. And again, that's your only down payment. I do have a lender, if you're gonna buy it as a primary, let's say this gap, this new example, 500K purchase price, 400K loan balance. If you put 5% down of the purchase price, so 25K, I have a lender that'll loan you a second. And so they'll loan you the 75K to help you cover the equity gap. And now you've got two loans, one massive loan at 2.5, and one second loan that's gonna be at 8 or 9%, right? They're at second position. But the payment on these two is gonna be way lower than if you got all of this at 6.5. So it's not a wraparound. It's just a second mortgage. It's called a piggyback HELOC. It is a HELOC, home equity line of credit. And I might lose some of you on this. It's not that big of a deal. It's a nuance. But it is a HELOC on the property you're buying that you get at the time of closing. So you're getting a loan on the equity of the property you're closing on. If that doesn't make sense, don't worry about it. But it's really cool, and it's a great way to buy a property if you don't have enough for the equity gap. Ton of misconceptions with this. A ton of agents that are like, they're just like, I'm not doing that, no way. A ton of people, buyers, sellers that have got a lot of misconceptions that is really important to explain to the listing agent so that they can then go inform their seller. Because if listing agents don't understand how something works, they don't want to look like a fool in front of their client, and so they just shut it down. So you really want to be able to explain this to the listing agent so that they can feel confident that the deal is going to close for their seller, and that they feel empowered to go educate their seller on how these work. So one misconception is that it takes a really long time to close. Assumptions were irrelevant for 40 years. Rates were super high in the 80s, and they just dropped until 2021, 2022, where they started going up again. Everyone forgot about assumptions. These were super popular in the 80s, but everyone forgot about them because you could get a new loan for a lower rate. So there's no reason to go through the assumption process. Lenders are relearning how to do it. Agents are relearning how to do it. Buyers and sellers are learning that they're a thing again. It's getting more popular. So the horror stories of like these take forever and they don't close are from where people tried to do it themselves a couple years ago. And banks hadn't really done very many of them yet. And buyers, sellers, agents hadn't done very many of them. And it was a super new, confusing process. And so it took 6 months, and everyone would give up and walk away, and they wouldn't do it. And so when they hear horror stories, that's what it's from. But now a lot of these mortgage lenders, the servicers of the seller, have done them. They understand it. They've got some systems set up. And there's a lot of assumption servicers that have popped up that will help you push these through, and they've done hundreds of them. They've got connections with all the banks, and they really can get them done now in sometimes 30 days, and most of them are closing in 60 to 90 days. Some of the slower ones are taking about 120 days, and it really depends on who is servicing the seller's loan, because some of them are really responsive and some of them are not. It's just, there's no correlation between big and small. Yeah, and credit union took 30 days. Veterans United takes 30 to 40 days.
I heard if it's like MERS, it takes longer.
What one?
It's like a bigger one, it takes longer.
Some, I mean, it's no, there's no correlation between that. But yeah, some of the big ones are terrible and some of the big ones are great. So you can hire a company that is really experienced in this that'll help push it through. And all my clients that do these, I won't do it with a client if they won't hire one of these companies, because it's going to take months and everyone's going to give up and walk away. The other misconception is that this is only for veterans. Any FHA, USDA, again, not relevant really to us, but any FHA loan is also assumable. And anyone can actually assume a VA loan. You don't have to be a veteran to assume a VA loan. The only way that a veteran's going to let you do it, though, is if they want to keep that portion of their benefit with the house. And I would say, for those of you that don't know, a veteran has VA entitlement, and they can buy a property with 0% down as part of their benefit for serving. They can do that up to $800,000 in El Paso County. So they could go get two $400,000 homes with 0 down. 1 year, go get the second one the next year, 2 years later, and use up their entitlement. So a VA seller, there's a lot of reasons that they would be willing to leave their VA entitlement. Maybe they've got a spouse that's a veteran. Maybe they only used half of their entitlement, they can go get another home with their entitlement. Maybe they're really doing well and they don't need to do a 0% down loan. and they've got a ton of equity in their home. They're going to go put a big down payment, right? So there's a ton of reasons that a veteran might be willing to do that. And we find that about 10 to 20% of veterans are willing to let anyone assume their loan. A ton of people think you need a lot of cash to do this. Again, I've had investors put less than 10K down. $50,000 opens up a ton of doors for you. And again, you've got the lender that'll help loan that second mortgage. If you don't have enough cash, you just got to have 5% of the purchase price.
So from a standpoint of it having to be a primary residence, do they care on the, I haven't heard much about the FHA assumables, do they care on that, on FHA?
FHA cares.
And VA, right?
VA does not care. No, I'll get to that. That was kind of the surprise.
Less they're better?
I'm going to surprise you with that in 4 slides. Yeah.
Give it to me in a minute.
FHA, you got to live in it. You got to intend to move in 60 days. You got to intend to live there for a year. All right, here's the benefits. I mean, we all know high level, right? Getting a 2.5% rate is much better than getting a 6.5% rate. Here's the actual numbers. 500K loan balance, 3.25 versus 6.8. The monthly payment is $1,100 less. So that's the benefit of assuming a mortgage. And this is not even close to as low as we typically get. A lot of the assumables are in the 2s. And then here's the breakdown for 5 years and then over the life of the loan. You're going to pay, same loan situation, same interest rate comparison as the last slide. You're going to pay $23K more in principal in 5 years. You're going to pay $88,000 less in interest in 5 years. And over the life of the loan, you'll pay $390,000 less in interest if anyone just holds on to that for the rest of the loan term, which not very many people are going to do, but that number's crazy. Again, not subject to, do not be confused. Subject to, you're going around the lender's back. You're hoping they don't know. And you got a ton of cover your ass paperwork. Assumables, the lender's involved the whole way. They're putting their blessing on it.
You're literally taking title.
You are, oh yeah, you're of course taking title, but you're getting everything about the loan transferred into your name. And the lender is doing that. Here's the process is pretty much the same. You find a house, figure out the loan balance. Can you afford the equity gap? Do you like the interest rate? Write an offer. Work with someone who understands how to do it. Get the mortgage transferred into your name at closing and close on the property. It's really that easy. To our bonus question from Ash earlier, right? Marketability. This is why a seller will do this. If they get another offer at asking or as strong as yours and it's going to close in 30 days, it's probably not likely they're going to take your assumable offer, right? It's going to take maybe 45 to 90 to 120 days. They're not interested in going through that process with you when they can close normally. But in a slower market and they don't have offers, they'll go under contract and hopefully sell their home via the assumable route all day long. So marketability and potentially a premium on the price. So what do we do to find these deals? I find all the FHA via assumables. I put them in a spreadsheet. I tag them all with all the info. I tag them with what type of loan they are. I even tag them with the veterans that are willing to let someone who's not a veteran assume it. And that's really important. Remember that. I'll come back to that. I set up email searches to find these properties based on clients' criteria. When I find a good deal, I'll run all the numbers. I'll send out a one-off email. Here's a couple people that have closed. Garrett put like 100K down and got a 2.25 rate. Caleb and Rebecca put 15K down and got a 4.5% rate. And these guys are investors. And they put 16K down on a $430,000 property and got a 2.9% interest rate. Yeah. Some of these are assumable by investors. Which type are assumable by investors? VA with what nuance?
leaving their entitlement?
If they're willing to leave their entitlement. The VA seller is willing to leave their entitlement with the house. Anyone can assume it, whether you're going to move in or not. So this is the best way to buy investment single-family properties right now. Here's the numbers on that one. I mean, this is a really awesome deal. This is a $16K down deal for a $430,000 property at 2.9% interest rate. First year, they pay $10K down in principal. If it appreciates at 3% a year, that's $12K of equity. So $22K of equity plus tax benefits on a $16,000 investment. That's, I haven't seen anything better than that in a long time as far as investments go.
Are you saying that those second position loans are comfortable giving you a loan at 95% because they're confident in the property itself, they have to bail out that first being at the 2.5?
They're willing to do 95 if you're going to live in it. So they're confident, like any lender, that if it's your primary home, you know, you're gonna probably fight to keep it.
Are these like
And
more private secondary like products, or are these like the same bank that you're doing the loan at the first?
oh, yeah, no, I don't know very many people doing these seconds. I don't think it's a super popular thing, but.
Yeah, I know people do seconds, but at 50% LTV, not 95.
A lot of the seconds stop at about, well, for primary is 90, but you'll see guys who will take a little more risk. And obviously the person getting loan is going to pay a little bit more for the risk that the lender's giving.
Like I said, the fees are probably
So the fees and rates are going to be higher, but like you said, if you're saving so much on the first, I mean, that's where the calculation of the first and the second would be, where that rate is, what the savings are.
because I know some people that do some seconds for some fees if you need more.
Yeah. So anyways, that's a great, you run the 16K investment and you're getting 22K of equity a year. So how do I find these properties? Let me show you how, that was like, you know, if you guys were asking that question, how do I find these properties? Here's a great site. This is my website, the Assumable guy. You can look at the properties and click around on these. This one's got a 4.125, $0 down. That means they have no equity. That also might mean that they're behind on their payments. So 0K down, I would clarify on that one. 130K down to get a 2.6% rate. 384K, right? That one probably doesn't make sense. 71K down to get a 4.98. You could probably buy the rate down that much. You know, that one may or may not make sense. 77K down to get a 2.7, right? That might make sense. So this is a great way to find some of these properties. Obviously, this is on the internet. You're more than welcome to use this. But this is a great way to find these properties. Any questions on that? I do a ton of like educational content too. So if you want to see me acting a fool or talking about interesting, assumable stuff, you can see me. You can follow me, and I'm, you know, every once in a while I have some good moves. So
Who's filming?
Jennifer, my girlfriend. So, good educational content on there, hopefully entertaining too. Just go through those and play them. Nice. That's all I got. What questions do you have about any of that? Question time. You got to qualify. Yep. So sub 2, you don't have to qualify, but there's a ton of risk, right? For these, you've got to qualify. The lender's going to take you through the qualification process. It's pretty much the same as originating a new loan. There's some slight differences that are more strict. The bank holding a 500K 2.5% interest rate would love to see that home sell traditionally, free up that money and go reloan it at 6.5, right? So they make the requirements a little more strict as they can. But at the end of the day, if they make it too difficult, they take too long, they will lose the ability to service VA and FHA loans, which is a massive part of their business. So they make it happen, but they kind of put up a fight sometimes. Someone had their hand up. No?
I had a similar question to him on qualifications.
If you're planning to get photos done on your next listing or rental property, don't forget to reach out to Wayne with Homati to get 20% off your next shoot. What percentage would you say of veterans leave their entitlement?
10 to 20 are willing to leave their entitlement.
If they haven't made, if they're behind on payments, can you still assume?
Yes, but you have to make them current. And that can either happen at closing. Some servicers will let you do that at closing, and that maybe the seller can do it with the proceeds of the sale if they have any equity. Some make you do it before you even start the assumption process. And then you're taking a decent risk, right? Like you need to put a lien on that house if you're doing that, to where if they ever sell it, you're getting repaid because you're making them current. And then you're going to go through the process and hope that you qualify and hope that the seller participates in that whole process, like after you just made them current. So there's risk there, but there's ways to mitigate that risk.
Triggering a question, have you worked with or seen any deals with an assumption that started out as a short sale?
Yes, I have. I don't know if I've closed any that have done that, but one of them was behind, and we were trying to figure out a way to make it current, but the servicer wouldn't let us do it at closing, so my buyers backed out because they already had a second loan, so my buyers, if they put a lien, would have been in third position, and that was not something they were willing to do. But yeah, it's a great way to help a seller avoid foreclosure. Like, hey, let's go through this assumption process. You can make yourself current at closing, or I can, or maybe it's a short sale, but they're not behind on payments.
So there's going to be a lot of short sales on the market. And if you go into the short sales and see if you can do an assumption, that's a way to exit out of that without them having that thing of the short sale under.
Yeah, it's a great win-win for everybody. A lot of these only work if they're a win-win for everybody. So.
What if somebody's already in foreclosure? Can you do anything about that?
I don't know I don't. If someone's already in foreclosure, can you do something about that? Can you, by assuming it, can you help them out of it? I would say I don't know the nuance of that question, but it's going to depend on the servicer. And most servicers don't want to go through a foreclosure process, so most of them are going to be open to saving everybody the headache of foreclosure and going an assumable route.
What would you say the closing costs are that you have to pay to the lender, not to the title company, in order to do an assumable?
Closing costs on an assumable are actually usually less. You don't have to pay new origination. You don't have to originate a new loan, and you do not have to do an appraisal. The appraisal has already been done when the seller bought the house, and that loan is staying in place, and that loan is based on that appraisal. So you don't have to pay for an appraisal. You don't have to pay for new loan origination costs. The only extra cost is going to be hiring one of those assumption servicers that helps push that process through.
So the guy who does the payback seconds, does he require an appraisal? Because then what value?
Piggyback seconds require an appraisal.
Okay.
Yeah, good question.
What if so let's say you said it's like starting like a brand new loan, like a new purchase. Can I use my own loan officer, or do I have to use one that specializes in assumable loans? And I think you answered it, but I just need clarification.
Yeah, that's a good question. That's the biggest difference in this process is as you're buying the home, you're not using your preferred lender, right? You do want to come with a pre-qual letter, and you figure out how to get that because you're not actually going to use that lender. You are qualifying with the seller's lender because they're transferring the loan to you. So you're going through that whole process with the seller's lender. And that's the part that takes so long. That's why it takes 45, 90, 120 days, because you're going through that process with the seller's lender. They don't have a department usually that does assumptions. They don't really get paid for assumptions. and they again would love to see that money freed up. So they're not really invested in making that process easier or efficient. Anything else? I'll be here if you got more questions. Thanks for coming out. Let's do a book raffle.
Yeah. We do have a very fresh book here that has never been read. That is the Long Distance Real Estate Investing book. If you think prices are too high in Colorado, you can talk to Sterling. He invests in Cleveland, Ohio. That's your guy. Read this book and you'll be great. Ready when you are, Ryan.
Let me sync it up in case anybody else signed in.
Thank you.
It will be off your email, so if you have a weird email, we're all going to judge you. Veronica.
You won.
Yeah. You're welcome. Thank you, everyone. We'll be here for another 45 minutes or so. Stay and network, grab another beer. If you have any questions, come up and ask us. Our next meetup is going to be May 8th, and we are talking about co-living. It's also going to be sponsored with Bigger Pockets, if you know them. And we're going to hopefully get a ton more people here for networking. Our friend Miller McSwain, he wrote the book on co-living for Bigger Pockets. So he's going to talk a little bit, and he'll be here to chat with you guys about what works for co-living in Colorado. So thank you.